Welcome to This Explainer. Today we're doing something a little bit different and honestly pretty fun. As an investment analyst, I look at dozens of companies a week, but today we're going to put Protolabs, ticker PRLB, through the ultimate investment gauntlet. We aren't just looking at their latest earnings report. We're going to break this stock down using the exact, strict frameworks of legendary investors, Warren Buffett, Peter Lynch, and Benjamin Graham, before finally stress testing it with modern discounted cash flow models.
Here's our roadmap for today. First, a quick company snapshot. Then we'll run it through the Buffett lens, the Lynch lens, the Graham lens, look at some DCF and alternative valuations, and finally, wrap it up with our synthesis and final recommendation.
All right, Section 1, Company Snapshot. Let's set the stage here. So, Protolabs is currently trading right around $61.11 with a $1.45 billion market cap. That puts them squarely as a solid, well-known mid-cap player in the industrials and metal fabrication space. But, what exactly is under the hood justifying that billion-dollar-plus price tag? Well, they're basically the ultimate rapid manufacturer. They generate their $533 million in trailing revenue by churning out prototypes and small batch parts super fast. Think CNC machining, injection molding, 3D printing, the whole shebang. And their client list? It's seriously impressive. We're talking major aerospace, defense, and medical device companies. Their parts are literally supporting NASA's Artemis II lunar mission. So the business itself is undeniably cool. But let's find out. Moving to Section 2, the Warren Buffett lens. Here, it's all about moats, management, and margins. You all know the Buffett philosophy. The Oracle of Omaha wants a wide economic moat, high return on equity, manageable debt, and incredibly consistent earnings. He's looking for those owner earnings, basically free cash flow. And he absolutely demands a margin of safety before he buys. Let's see how Protolabs actually stacks up against this. Okay, look at the sheer tension in these financials. On one hand, you've got a balance sheet Buffett would normally drool over, a massive $128.1 million cash fortress with zero major debt. That is a fantastic financial moat. But then you look at the operations. Their net profit margin is razor thin at just 4%, and return on equity is sitting at a pretty dismal 3.2%. And while they did have a recent earnings pop, if you zoom out, their 5-year earnings trend has actually been shrinking by about 3.6% a year. For a guy like Buffett who wants capital compounding machines, that 3.2% ROE and slipping long-term earnings, that completely fails his test for robust, predictable profitability. So what's his price? If we take their $51.64 million in free cash flow as our proxy for owner earnings, apply a super conservative 10x multiple, which, let's be honest, is fair given those thin margins, and then bake in his signature 20% margin of safety, our math says Buffett wouldn't even bat an eye at this stock until it drops to around $41.31. At $61, it's a hard pass for the Oracle. All right, let's switch gears to Section 3, the Peter Lynch lens. This is all about growth at a reasonable price. Now, Lynch made his fortune at the Magellan Fund hunting for multi-baggers, and his absolute favorite tool was the PEG ratio. To quickly recap, the PEG ratio just helps us figure out if we're overpaying for a company's current growth spurt. Ideally, you want a PEG of 1.0 or lower. First step for Lynch is always categorizing the stock. Looking at his classic buckets, Protolabs fits best right now as a turnaround story. Why? Because they just delivered a massive 28% trailing earnings pop. They had a killer Q1 2026 where non-GAAP EPS jumped to 54 cents, up from 33 cents the year before. And this is all happening after years of pretty sluggish contracting earnings. Plus, you could argue they've got some asset play flavor too, thanks to that giant cash pile. But here's where the Lynch thesis really hits a wall at today's prices. The stock is currently sitting at a sky-high trailing PE of 69.4. So even when we factor in that impressive 28% recent earnings growth, our calculated PEG ratio comes out to 2.47. That is way above Lynch's ideal 1.0 threshold. So while he totally respects the pristine balance sheet and that turnaround momentum, the PEG ratio makes this a definitive hold for him. You're just paying way too much for that growth. Next up, Section 4, the Benjamin Graham lens. We're talking the father of value investing himself. Graham is notoriously ruthless with valuations. If we run Protolabs through his strict defensive investor checklist, it's honestly a mixed bag. They easily clear the adequate size hurdle with that $1.45 billion cap. Strong financial condition? Pass, easily, with $128 million in the bank. Earnings stability? Pass, again, with positive trailing net income. But then, boom, brick wall. Graham demands a moderate PE ratio, usually under 15. Protolabs is hovering near 70. Big fail there. Let's crunch the numbers on Graham's famous intrinsic value formula. The math is pretty straightforward. You multiply 22.5 by the earnings per share and the book value per share, then take the square root. Plugging in their trailing EPS of 89 cents and an estimated book value of $33.12, the formula spits out a brutal, unforgiving fair value of exactly $25.75 per share.
So if you buy in today at $61.11, you have absolutely zero margin of safety, according to Graham. For him to even consider Protolabs, the stock price would practically have to be cut in half. It's a definite no from the godfather of value. Okay, so the classic gurus say it's way too expensive. Let's look at modern Wall Street methodology in Section 5, DCF and alternative valuations. We built out a standard base case DCF here, starting with their current free cash flow of $51.64 million. If we assume their future growth mirrors that recent top-line revenue bump of 12.1%, and we use a standard 10% discount rate along with a 2.5% terminal growth rate, our model values the company at $48.50 per share. So even projecting out steady double-digit growth, our modern metrics are still saying the stock is overvalued today.
And when we run a sensitivity table, things get even clearer. To actually justify today's $61 price tag, you'd have to look way up in the top right quadrant. You essentially need to assume an aggressively low 8% cost of capital combined with highly optimistic perpetual terminal growth. Basically, if they stumble even a little bit, or if interest rates stay high, the downside risk you're taking on is massive. Looking at a few alternative models really just confirms our suspicions. A forward PE of 30.8 tells us the market has already priced in a flawless operational turnaround and massive margin expansion. They're trading at a huge premium compared to digital manufacturing peers, like Shapeways, largely because Wall Street is just willing to pay up for that totally debt-free balance sheet. All right, let's bring it all home with Section 6 synthesis and final recommendation. Let's see what all these models are telling us together. When we line up every single framework side by side, the narrative is glaringly obvious. The stock is currently trading well above every theoretical fair value we calculated. Graham says $25. Buffett says $41. Even a pretty generous DCF says $48. And yet, the market is asking you to fork over $61 today. So what's the final verdict? Look, Protolabs is without a doubt a fundamentally sound business. They're doing incredible high-tech manufacturing with organizations like NASA, they've got crucial aerospace certifications in Europe, and they have the cash to weather almost any storm. But as analysts, we have to separate a great company from a great stock. The glaring risks here are those incredibly thin 4% net margins and a valuation that absolutely demands perfect execution for the next 5 years. So at $61.11, this is a clear hold, and if you're a strict value investor, it's honestly a sell until the price comes back down to reality. We know the gurus want it cheaper. Graham's waiting at $25, Buffett's hovering at $41, and the DCF model needs it around $48. But based on this gauntlet, and knowing the undeniable potential they have in the future of digital manufacturing, at what price does this 3D printing titan become your perfect buy? Think about your own margin of safety. Thanks for joining me on this explainer, and I'll catch you next time as we put another company through the gauntlet.